All right, thank you for joining us once again. I have here with me Brefo Asante George, a learned colleague of mine from the University of Ghana. So today's discussion is basically about the global financial crisis of 2007, 2008. So we are going to look at what the impact of the financial crisis were at the time, the corporations that it affected, and is it possible for us to have such incidents again in the future, and what will most likely cause the global financial crisis from happening again. So you'll be asking, what is the global financial crisis of 2007, 2008? Basically known as the global financial crisis, was a severe worldwide economic crisis considered by many economists to be the most serious and devastating financial crisis since the Great Depression of the 1930s. It resulted in the collapse of large financial institutions, the bailout of banks by national governments, and downturns in stock markets around the world. Now, the causes of the global financial crisis were a lot of, factors given by various economists, including housing market bubble, financial products, regulatory failures, global imbalances. So today we are going to discuss the global financial crisis and future possibilities of such occurrence and how best we can tackle it. So without further ado, I would let my little colleague here assist me with a few of these questions. And thank you for joining in again. Don't forget to subscribe to this channel. George, are you there?
Yes, I'm here. I'm here to graph.
Okay. All right. So just as always, I would love if you articulate a bit so that it will be more clearer.
Oh, okay. I hope
Okay.
it's okay now.
Yes, it is.
Okay.
And this Zoom meeting would end in the next 22 minutes. So maybe we can just keep the answers very succinct and simple so that I can move on to the next questions and be done with all the ones that I have here.
Oh, okay. Okay.
All right. So uh, first of all, can you provide an overview of the key factors that led to the global financial crisis of 2007 to 2008?
Oh, okay. Thank you, the graft. Okay. From your introduction, at least you made mention of some of them being the housing, fall of housing prices. So with the 2007-2008 financial crisis, the principal cause was the fall in housing prices. So
Okay.
like financial crisis itself, we can say is a disruption of the financial system as a result of sharp fall in asset prices and failures of financial institutions. And when we talk of the fall in asset prices, the housing comes into it. And the issue is that housing prices falling was not really the issue. The main culprit was a subprime mortgage. So for instance, in US, for instance, we have subprime clients. They are clients who, when you give them loans or take loans, the high probability that they are going to default. So we had a subprime mortgage. So that means that a mortgage for people who are highly toward default on its payment. But here is the case that the housing prices became possible because of a political decision, the American dream. Everybody has to own a home. So
Okay.
there was lax in regulation. So much of the regulatory stuff that has to be enforced was relaxed so that banks will be able to give loans to people who previously could not afford. And it gave room to the lending of monies to these subprime clients. And when this thing happened, the surge in subprime clients, taking on mortgages, and the financial, industry took advantage of it through securitization. So now, previously, if a mortgage or financial institution is to give loan for mortgage, they make sure that they assess the client that the client can pay because that loan is going to be on their books. But with this new securitization, the loan is not going to be on the books of the financial institutions. So it's bundled and sold out to investment bankers, who also breaks them down into tranches and sells them to investors. So investors get their money when what people who have taken the mortgage
Loan. Yeah.
payment. So here is the case: you have a section of the mortgage, the subprime clients, subprime mortgage encountered an issue 2006, 2007 when the housing prices started falling, and subprime clients started defaulting. So when they started defaulting, a lot of the big banks or investment banks have got a lot of portfolio of subprime investments. So you can see the effect or what is going to happen. So it triggered what became as a crisis, because a lot of things came into play, because the subprime, the housing prices was linked to a whole lot of stuff. The securitization chain, everybody was involved in it. So this
Okay.
triggered the crisis.
Okay.
And when you talk about this other aspect of it, because the housing prices was the principal cause, then
Okay.
there were other things that made it worse.
Okay. Okay.
You
All
see?
right. So so the major cause, as you said, was the was the housing crisis, right? Everyone wants to live the American dream.
Yes, and
Okay.
that section of the housing was the subprime.
Okay.
So
Okay. So
subprime were people who were highly to default. But prior to 2007, we had this group being given loans. People
okay.
were even took loans and they didn't understand the terms. They
Yeah.
even called it the ninja loans: no income, no jobs. They give you the loan, mortgage
Okay.
loan.
Okay.
Yeah, so that was the situation there. And they were predatory lending. People were giving loans to people they knew could not pay. But
Mm,
because it will not be on their books,
yeah.
you see, they were giving it out. Then the more they give out loans, the more they make their money, because they are going to sell it to investment banks, who will
Yeah.
then what break them down and issue it to investors. And you
Okay.
had rating agencies who could not, look in details about what the mortgage was, but they gave it triple A as investment grade, and you had pension funds buying into those things. So you can
Okay.
imagine the repercussions.
Yeah.
Yes.
Okay.
So the
So with that said, what were the most significant impacts on the financial markets and the banking sector, I mean, generally during the crisis?
oh, okay. With the financial institution, for instance, okay, let me give this scenario. Oh, what happened? For instance, AIG, American International Group, an insurance
Mm,
company.
yeah.
For instance, AIG was also involved in this mess, because AIG sold billions of credit default swap. In that, the credit default swap is basically AIG is telling you that pay me a premium, and when the debt that you have in your books, in the event that the payment is defaulted, AIG is going to take on that debt and give you your money.
Yeah.
So, but AIG believed that the market was going to continue in such a way that there was no way there's going to be a disruption.
Mm,
So when this thing happened, when this occurred, the financial crisis occurred, AIG was found wanting, and the government has to intervene. Government bailed AIG out with 85 billion, saying that if AIG is allowed to, go bankrupt, the disruption is going to be as it will even be equal to the 1929 Great Depression. What happened? You see, but prior to AIG, we had firms like Lehman Brothers. They failed because they've also have a lot of holdings in the mortgage-backed securities, which is the subprime. And before Lehman Brothers, we had the fourth largest investment bank, the fifth largest investment bank, Bear Stearns, which was also involved in this mortgage-backed securities, which is the subprime. But the issue was not even about the housing prices falling, but it was about their leverage. you see that, for instance, leverage, which is the ratio of asset to capital. If you create an asset worth 100 and the liability, creating the 100 asset, you borrowed 80 with your capital 20. So if your leverage will be, that's the asset which is 100 over 20. So your leverage is 5. But let's say you create an asset of 100, then you borrowed 95 and your capital is only 5. That means that you have a leverage of around, let's say, 20. So if housing prices should fall, you can imagine the disruption that is going to cause the financial institutions. So the disruption that the financial institutions experience resulted in insolvency, bankruptcy, and which created this credit crunch. Financial institutions were unwilling to borrow, to lend. People
Yeah.
were also unwilling to what spend. So
Yeah.
aggregate demand was affected. And you know that when aggregate demand is affected, it in turn affect the whole economy.
Exactly. Employment and everything. So it was cyclical.
Yes. So it was the vicious cycle. You see, the effect was that it was not up, it was cascading. So when this one happens, it triggers another one. When this happens, it triggers. And so you have, for instance, in UK, we had a bank, Northern Rock. They were also involved deeply in the housing securitization. And
Yeah.
they applied for their central bank for liquidity. When their customers get to hear of it, they went to the bank to withdraw their money. And for the first time, people were seeing bank run. Bank
Wow.
run, like people going to withdraw their money. And you see
Yeah.
that because, and healthy banks will be affected because people think, if this bank is going, people are withdrawing their money here, it may affect my bank, even though my bank is healthy. I
It's
might
doing
go there
well.
also to also withdraw my money.
Yeah.
You see, so Northern Rock was the first casualty in UK.
Mm.
You see, and you had banks, a bank in France as well, BNB Paribas. They were also involved deeply into it.
Yeah.
And
Okay.
because of
So,
this,
the questions around this topic are enormous, you understand? And I know you have a lot to say about it. So
oh yes,
I'll just go on to the next question. And I mean, I don't know if maybe we should devote another time to talk, I mean, more on this, but let me go to the next
okay.
topic. I think the question I asked you, answered it. So, like, how did the crisis influence the lives of the ordinary people and even businesses?
Okay, thank you. For ordinary person, here is the case: the households have increased their debt level because a lot of them have taken mortgages. And here is the case: housing prices are falling. That means that your debt is, your mortgage is even, it's kind of, it's not enough to cover for your debt.
Yeah,
You see, so that was why there were a lot of foreclosures. People were not able to even make their mortgage payment. So they have to leave their houses and sleep outside. So because now the asset that they are paying for is now worthless.
yeah,
You see the thing. And when you come to the business wise, because financial institutions are having issues, people, some are deleveraging. They have a lot of debt and they are deleveraging. They were unwilling to lend. You see the thing. People were unwilling to lend because now they are going through trouble. So they are trying to, keep the balance their books to make it, nice.
yeah,
So they were unwilling to, make new loans. So businesses who needed money for investment were finding difficult accessing loans, and that's a credit crunch.
mm,
People is like there was no money available, and if there is no credit, how can the economy be stimulated? Because businesses who run on credit for their operations, they are not able to access it. So
yeah.
it's going to affect their operations, which will also affect unemployment and other stuff as well. So
Okay.
that basically, I would say, how ordinary individuals and businesses, how
Okay.
they were affected some way or the other.
Okay. All right. Do you think we've learned